through that data. Last thing we need is what I call a tight picture of power, and I'll teach you what that is. Now, here's a 2-minute chart of 50%. Then their account goes to 250,000. Then their account goes to 500,000, and it goes on and on. My top trader has a little over $30 million trading with. Now, this is what your path is in my organization as a trader. And the least you know, usually the better. I love blank slates, to be able to paint my masterpiece on blank slates. All right? So now, I want you to pretend like you have $50,000, and I'm going to teach you how to take the $50,000 and run through that list. All right? We're going to need several tools. 5, in fact. $50,000 to start. Number 2, we need a 2-minute chart where every bar in the chart represents 2 minutes of trading. So we're going to divide the market's activity into 2-minute slices. We need a simple 20-period moving average running through that data. And we need a simple 200-period moving average running through that data. Last thing we need is what I call a tight picture of power, and I'll teach you what that is. Now, here's a 2-minute chart of Facebook. Every bar represents 2 minutes of charts. Obviously, the green bars mean that the stock opened at the bottom of the green and rose to the top of the green. All red bars mean that the stock opened at the top of the red and fell to the bottom of the red, okay? So green bars are up bars, red bars are down bars. Now, we need a 20-period simple moving average, which is going to average the last 20 bars so that we see a 20-bar average, and we want to see a 200-bar average. So there's a short period moving average, a short one, and a long one. Moving average systems, you always want to use a short one in conjunction with a long one. Okay. Now, I've superimposed the 20-period moving average and the 200 on that same chart of Facebook. Take a look. The one sloping downward is the 20. The one sort of flattish is the 200-period moving average. Now, let's talk about the states. When these two moving averages are close together, we call that a tight state. Your stock or Facebook, when those two are close, the market or Facebook is in a tight state. When those moving averages are far apart, Facebook is in a wide state. So I want you to understand that the markets have 2 states. We flow from narrow to wide and back to narrow to wide. And that's it. It's almost like the market is a breathing mechanism. It breathes in, tight, and then it exhales out wide. And after wide, we go back to what? Inhale. And then after inhale, wide again. Now, we judge these states by the moving averages, the 20 and the 200. So you can have a tight, narrow state with the 20 above the 200, but tight and narrow. Or you can have a tight, narrow state with the 20 a little bit below the 200. Here's a wide state where the 20 and the 200 have separated, but separated to the upside. The 20 is above the 200, and you have from this wide state, you're expecting your stock to drop from a wide state because the drop brings you back to narrow. Now, if you have the wide state to the downside, the 20 has declined away from the 200. You're looking from that wide state, what should your stock be ready to do now? To back up, to go back to narrow. So if you can start by knowing the stock's state first, you've got 85% of this game already figured out. Most problems come from playing the wrong state. Buying after this. After a wide state. Or during the reverse. So get the state right, and you've got 85% of your problems in trading are gone. Okay? Now, let's go back to the Facebook chart. Look to the left-hand side of the chart. Look at the left-hand side of the chart. What state is the left-hand side? Narrow. Your best opportunities come from a narrow state. I'm going to repeat this. Your best trading opportunities come from narrow states. From narrow states, there is usually an explosion out of the narrow state, and there's flow, there's follow through, there's trending. Your second best opportunity comes from where? The wide state. And in the wide state is when you become what kind of trader? A contrarian.
All right. So y'all heard it from Oliver Velez, not me, right? Did everybody understand that video? Please drop a 2 in the chat if you need more clarification. Did everybody understand what we just saw? This is very important. All right, it's not my concept. It's Oliver Velez's concept. Now, anyway, what do you mean you got to go back and listen again? Let me paraphrase. I mean, you can go back and listen again, but let me paraphrase what Oliver Velez said. He trades a moving average concept. He trades a 2-minute chart, but I've followed Oliver Velez for long enough to know that you can trade this on any chart, right? It doesn't matter the time frame. The market is fractal. If you see it on the 2-minute chart, you'll see it on the 1-hour chart. You'll see it on the 4-hour, the daily, the weekly, so on and so forth, right? Naturally, the larger the time frame, the larger the move, okay? So if we look at this chart of CAD CHF, let me just get rid of everything. CAD CHF, we can go back, however far you guys want to go back. And the proof of concept, the concept that he's talking about, if we take this section of the chart here, this is what he was talking about a narrow state, okay? Now, pip-wise, this is a daily chart, guys. Pip-wise, this is anywhere from 131 pips, to, let's just call it 150 pips. But it's still a narrow state. You still have the moving averages close together, and you have the price all close together. Then if you notice, you get this move up, right? Price starts pushing to the upside. So you get a break, you get a retest of the moving average, and you're off to the races. What Oliver Velez said in that video was, this is your best trading opportunity, right? If you can catch, he used the word stock, but this works on anything you're trading. Options, it doesn't matter. If you catch your instrument in this state, you're going to catch a heck of a trade. So if you look from the time that this retested and pushed up, if you would have recognized what state you're in, you're over 550 pips in the green. It runs all the way up to what he calls the wide state. All right. The wide state is moving averages are separated. Okay. What is not mentioned in that video is once you get the price above the 20 and the 20 above the 200, this is called the picture of power. And this is to the upside. You'll get the same thing if this was a narrow state and the price crashed and went to the bottom side, you get a picture of power to the bottom side. If you guys are interested in learning, his teachings, you should follow his page. But you get to the wide state. What happens?
I'm sorry. You said if you get the price above the 200, after that, I lost.
So you have the price above the 20 and the 20 above the 200. That's called the picture of power to the upside.
You said picture, and I could just look that up. Is that like a thing?
Yeah. Oliver Velez talks about it. You can't miss it. Picture of power, Oliver Velez on YouTube. It might be 20 videos to come up. I don't know. But he is the moving average guy. Like this is his system. So
you said 20 over 200.
This is the 20 period moving average.
Okay.
Does everybody know what a period is? 20 period moving average. This is basically a tally of the last 20 period. The period on this chart is a day. So 20 days, the closing price of these candles are the last 20 days. It plots this line. This is the 200 period moving average. Period is whatever chart you're on. This is the daily. So this is an average of the last 200 days closing price. So it gives you these lines. What Oliver Velez said, your best trading opportunity comes from a narrow state. The market explodes to a wide state. You shouldn't be looking to buy at the wide state is what he said. You should be a contrarian. You should trade against the trend. Trade it back to the narrow state. That's what he said. This is what he teaches, okay? And if you trade like this, you can see that it can work, right? Well, the only thing you're worried about maybe is the accuracy or the timing of your buys and sales. I just want you to pay attention to what you're seeing. The market comes back to the narrow state. It goes wide. It comes back to the narrow state. It goes low, picture of power to the low side. So he didn't, from what you can see here, there was no lies told, right? I mean, you can see the scenarios playing out. So
I have a question. So earlier in your first example, you were saying that after the narrow state, there was a break and retest. Will there always be a break and retest before it explodes?
So
that's the terminology.
No, the market doesn't have to do a break and retest. I mean, you like to see it, but it doesn't necessarily have to do a break and retest. You see it a lot along these lines, but sometimes you're just going to see it push away. The retest comes a couple of days later or several days later. So you can anticipate things, but there's nothing that's set in stone about the market. What you're going to have to do as a trader is you're going to have a bias and you're going to have rules. This is where your rules come in. If you only enter a trade after a retest, then you won't even worry about it until it retests, right? But you're going to have to come up with a set of rules that benefit you as the trader. And one of the hardest things to do, and the reason why trading is so difficult, is because any other job that you ever get comes with the rules, right? If you play football in the National Football League, there's a set of rules, right? You got to come to practice at this time. You got to do mandatory workouts, training camp. You have film study, all this stuff. These are rules, right? You can't take this drug. You can't. Trading has zero rules. It's a blank slate that each individual writes down the important thing. They write down their work schedule. They write down their study time, right? So that's why most people can't succeed in trading, right? Because most people need to have parameters set for them. We are not taught as people to set our own parameters. We're taught that these rules already exist. You know, if you're brought up and you believe in God, there's a set of rules, right? If you believe in Islam, you know, they believe in God too, but you know, if you believe Islam, there's a set of rules, right? Most of us have a set of rules, even if you don't believe in God or you don't have a religion. Maybe you're atheist. You grew up in a system. In the government, there's a set of rules. There's a set of rules already. You don't have to make your own rules. In this environment, you're required to make your own rules, and nobody is coming behind you to check you. So if you're successful in creating a set of rules, you can trade any system. You know, any system that you want to trade, you can do it. You just have to come up with your own rules. So what I'm doing here is showing you what he just said, right? Narrow state, price pushes up to the wide state, price pushes down. We're right back here at the narrow state. Now, this is where we as traders have to come in and do our own analysis, right? And this is where it becomes important for you as an individual to be able to do a good analysis, right? So I know that I'm in a narrow state, right? And even when I go to this weekly chart, you're going to see we're in a narrow state. Pushed down, came back, we're in a narrow state. It pushed up. In my opinion, this is my retest, man, right? So I have the theory that we're going up, right? Because I can look at this chart and say, hey, man, these lows are getting higher. I can look at this chart and say, hey, man, these highs just got broken, right? So if we went into consolidation and we broke the new high, now price is coming back to retest. It looks like we're getting rejection right at my 200. This is all systems go for me. But let me just make sure, right? Let me throw me a Fibonacci on here. If you know how to use a Fibonacci, that's cool. Fibonacci just measures retracement, right? So this is the high. Market came from here to this high. It pulled back past my golden zone to my 78.6. Now, y'all know I love some ICT. And ICT says the optimal trading entry is at the 78.6. So once the market pulled back here, this was my best opportunity to enter the market. So
there's an order block right there too.
What's that?
There's an order block right there too that hasn't been mitigated.
Well, I understand that, but I just you can find any confluence you want, right?
Oh, okay.
Everything that you know as a trader is vitally important when you do your analysis, right? Because it's not just one thing that's meshing. There's a series of scenarios that are playing out. I have a favorable fib reading. I have structure. I told you guys before, the number one thing in trading is structure. Structure. I don't care about anything else. If you know market structure, you're going to be a successful trader if you know and you follow market structure, right? So if you're trading support and resistance, one could say this is a level of support. This is a level of resistance. Price comes from this support, breaks through the resistance, retest now this support level. The retest holds. Remember, these aren't lines, these are areas. And now it pushes up past this level of resistance. Now it retests again, it broke through, but you knew it was going to break through because it came back to your optimal trading entry. Now you're expecting the market to push up. If you if you understand structure, this level that was broken right here, these highs right here were broken. You know, you expect the market to pull back to either the order block that sponsored the break or an imbalance in the system. In this case, you got it to pull back to the order block. So we should be off to the races to the upside. That's just the levels of confluence playing out, right? So I told you the Oliver Velez theory about the narrow state. So you have that theory playing out. You see the break. You see where price broke. You see the retest. You have the favorable fib. You have the market structure in your favor for a buy. I mean, how many different confluences do we need to enter the trade for a buy, right? The last thing you need is where you can take the trade to, right? So if I squeeze the chart, the first place I can take this trade to is to these highs, right? Then I can take the trade to this next high. And if you want to, you can put this bar at the second high, but just be conservative. So that might be TP1, this might be TP2. And then if you want a TP3, you want to come to this next high. All we're doing is following the structure points as price pushes up. Now there is a line of thought out there for Fibonacci users that says when you get your pullback, right? You get a pullback at least to the golden zone, you can expect the price to push up to the -27 extension, right? I'm going to put a mark up here because I subscribe to that. I think that that's pretty decent. I'm not necessarily a Fibonacci trader, but I do believe in pullbacks and whatnot, right? So if you just take the, I don't know, 5 different confluences, right? We have break of structure to the upside. How many confluences do you guys need to get into your trades? Do you have rules?
I usually have 3. 2, yeah. Do you want us to just answer in the chat?
No, that's fine. 78.6 pullback. You got the break of structure. You got a 78.6 pullback. You have the market at a narrow state. What else do we have?
You have consolidation and you have an order block.
We have a tap into the demand zone, right?
Mm-hmm.
So you got 4 different influences that I can think of at this point, right? So why wouldn't you take this trade? Anybody? Bueller. Y'all just silent, boy.
I have a question. Okay, so when you were talking about the different TPs, I know when we were talking last time, you were saying like adding to your entry. Would this be a time where, okay, if it hits TP1, that you would find a retracement to enter into your second?
But if you're just entering a second position at TP1, you probably missed the boat on it.
No, I'm talking about not entering at TP1. I'm saying, because different people do it different ways. So I don't know how you do it. Like, do you just put in 3 positions and then TP at each? at each take profit.
Stacking time, like how you stack.
Well, I know what she's asking, but
Oh.
what I'm telling you is if you're stacking at TP1, you're way late. So I think what you need to do is, as a trader, you have to decide.
So I need to stack at my entry.
Well,
Is that what
you have to decide that.
Oh, I know what he's saying. Okay, I get
You
what you're
don't
saying.
you don't stack at your entry, right? But you have to decide what time frame you're going to use to stack. That's a trade management decision. So this is what I mean, and I don't want to talk around what you're saying. I don't want you to feel like that, but I want you to understand that there's one trade manager. That title belongs to you. You click that buy button, you are the trade manager. So what that means is, if you're comfortable with seeing breakup structure on the 5 minute, maybe you're adding on the 5 minute. I would never do that. I'm comfortable on the 15 minute, right? But other people who aren't comfortable, they would never use the 15 minute. Maybe they're going to use the 1 hour. Maybe in a trade that we're targeting all these pips, maybe they say, you know what, I'm not going to be greedy. I'm going to add on the 4 hour pullback. What does that mean, right? So if you look at the 4 hour chart, and this trade is going down, you get a pullback here. That's a pullback on the 4 hour chart. Maybe you add to your sell position. It drops, it pulls back. You add again, it drops again. Now this is turnaround going up. So if you had got in at the very bottom, see how it pulled back? So you could add again, right? So maybe you're doing this on a 4 hour chart. I can't tell you that. I can tell you where I do it, but what I do is not going to be good for everybody. And that's what we need to understand. And, you know, I might use a 5.6 lot size. That might be too big for the next person, right? I use 1%. That might be too big for some people, too small for other people. I always recommend using 1% per trade. I think you'll make plenty of money that way, right? But other people, and I can tell you what I know, like the successful traders and big money traders, they're going to weigh, you know, they're going to weight their trades. This trade right here is probably in the high 90% possibility that it's going to work out. You have 1,000 different confluences. So this trade might be an excellent trading opportunity for, like, let's say Oliver Velez. Maybe he jumps on this with 2 feet. Like, he doesn't risk manage the same way I do. But again, he has a set of rules, and those rules, he applies them the same way every time. It's the consistency that bolsters the performance, right? You can't be one way today, and if you lose a trade, I'm changing that, and then tomorrow you're a different way. You have to have a system, and you have to stand by that system, 10 toes down on your system, and you got to ride with that joke. So maybe in this particular trade, if this your first time adding to it, you need to add from a higher time frame. You understand what I'm saying? You don't need to add as many positions as I add, because I'm used to doing this. I'm not new to this. I'm true to it. You know, I'm adding my positions as this pushes up. And I might add a position on the 15-minute chart. I might have 7 positions by the time I get to TP1. It's okay if you have 2, because this is unfamiliar territory. You understand what I'm saying? Does that make sense, guys? You can't be pressured into doing something because you see me doing it and it makes a lot of money for me, because I understand what I'm doing. You as a trader might not be comfortable in that environment yet. So you have to take a more cautious approach. So in this trade scenario, right? Did you guys make y'all's demo accounts? Okay, we're going to get into this trade, and we're going to do it a little bit differently, all right? Because whenever the market opens, they're going to have some crazy spread, right? And once that spread goes down, I'll drop a signal in the chat, in that swing traders chat. It'll be for everyone. I'll drop a signal and I'll say buy CAD Chef, right? And what we're going to do is we're going to put our stop loss in this case below this wick, right? We're going to put our stop loss below the wick, and we're going to just do a market entry. We're going to do it at a 0 on lot size. I just want to show you the proof of concept, right? Like, this is not my concept. This is a concept. This narrow state to wide state is a concept that can be traded. You understand what I'm saying? Like, this is somebody's go-to every time. Okay, I see my setup is when we're in a narrow state. Now I've just got to wait for the market to break one way or the other. In this case, if we had saw this several weeks ago and we got this bullish order block at the 200, maybe we'd have been in the trade right here. We'd have took this trade all the way up. Now, this is considered a breakout trade to a lot of people, but it's a breakout trade on the weekly chart. The concept says we're going to push. If we cross over this 200, we're going to push, right? There's the picture of power. It was perfect. Now, once this trade starts pushing back towards the 20-period moving average, you get out the trade or you sell it. You understand what I'm saying? That's the concept here. So some people on this call they don't even know how to find trades, right? I've been there. I understand that. I'm just giving you people's concepts that are like, this is a valid concept from somebody who's been trading since 1983. It works. But this is your first time being able to go to the charts and see it and be able to catch you an entry. I'm gonna tell you, I've been doing this for 2 years and I've never caught a trade at the weekly, at the 200 on the weekly. So this is my first time seeing this on the weekly, right? And a lot of it is due to me switching trading styles and all that good stuff. Now, as I analyze my pairs on the weekend, I'll throw my moving averages on. I'll throw whatever, just to see. I'll pull back to try to get a bigger picture of what's going on in the market, right? So if you look at this, the market came down, it pushed to a new low. Now you're getting higher highs. So maybe if you go to the monthly, maybe you get a swing low right in this area. Maybe this, in fact, let's just go to the monthly. Yeah, so it looks like, that it is. This is a swing low area. You have a low, you got this low, and now you have higher lows. I mean, this is another level, of confirmation, right? There's a monthly order block. You got the tap in right here. We're definitely pushing up. We're probably pushing up to this order block. Look at all that imbalance. Easy money. So y'all understand how, do you see how a little bit of analysis, a little bit of confluence will help you see the setup, right? And I'm not saying that this is going up here this month. That's not it. But what I'm saying is we have multiple confluences saying that this is a buy. We have the break obstruction. We have the narrow state. We have the moving averages that crossed over that says we're going to the upside. So you have all these different confluences. It's just time to take the trade. Now you just have to take the trade and you have to trust your analysis. Okay, do I have any questions on that setup?
I have a question about the moving averages. Is it smooth? What's the settings for the moving averages?
Simple. Now, Oliver Velez he does a lot with moving averages. So I really suggest you guys, if you're going to incorporate some of this stuff, that you go to the source. I know how it works. I've traded it. I've had success with it. But if you're going to do something like this, you must go do your research, right? Maybe Oliver Velez says something in those video series that resonates with you. Maybe something he says resonates with you that didn't resonate with me. So,
Oh, I'm sorry. When you're finished, I have a question.
go ahead.
So, you know, I don't like trade regular pairs. So to avoid like a fake out or something, do you usually risk about like what, 30 to
I trust my analysis. And
40 pips? No, I'm just saying like,
wait. You struck a nerve. All right.
I wasn't trying to strike a
No,
nerve. I just,
I got
just trade regular pairs.
but listen, y'all, listen to what I'm telling you, man. If you trade marbles, if you trade rocks, if you trade jacks, you can trade love letters. If it has a chart, it has structure. Trust your structure. I don't care if it's a US 30. I don't care if it's NASDAQ. I don't care if it's pork bellies. If it has a chart, it has structure. We're trading structure, right? The structure is telling you that the price is going up. Why would I risk less when I have all these confluences? Why would I risk less? Why would you risk less? Because you're scared?
Maybe you don't understand my question.
I don't. So can you please repeat it?
What I'm asking you is, generally speaking, right? Okay, we're gonna take this trade. Would you risk? Okay, so me usually, like if I'm taking a trade, I'll base my risk on an order block, right? But I know that's not all. That's not the only confluence that you use. So I try to catch the body and maybe sometimes the wicks.
Okay, now I understand your question. Okay.
But I just wanted to know, like, generally speaking, on like regular pairs, how much do you?
No, let me answer your question. So you're saying if this pushes down, like it says it's going to come back down, and let's say you enter the trade here and your stop loss, let's say you're going to push your stop loss up higher. So you're saying like risk as far as what you're protecting this order block only?
Well, no, well, I'm open to how I would do it on a high, well, this is a 12-hour, but I would make sure that I have enough space in case it decides to go deeper into.
I agree, which is why I said we was going to protect that wick. So like this.
But that's why I was asking you, because this is different for me.
So, but you mentioned a percentage. That's why I jumped on you. You said, am I going to risk less than 1%, right?
No, that's not what I said, but it's okay. Now that we're on the same page, it doesn't matter.
Okay, yeah, that's cool. So some people do, they get kind of scared of risking what they would normally risk. And it strikes a nerve because as traders, we have to be robots. You do your analysis and you do what your analysis tell you. If your analysis says this is a buy, you buy it. If it goes against you, you lost the trade. It happens in trading. We're going to lose trades. So never sell yourself short because you don't trust your analysis. Now, if over a period of time you say, you know what, 1% is just too much to risk per trade, I'd rather risk 0.5% for every trade. And you go to 0.5%, hey, that's you. There's nothing wrong with doing that. But what you don't want to do is start changing your percentages up, because you might lose all the ones you risk the 1% and then win the ones that you risk less than 1%. And over time, it's going to kill your PL. Just be consistent. Trust your analysis. Do your analysis properly,
So normally when you get into a trade, you're going to just account for the wicks, right?
You said account for
that's
what?
what I do, but
For the wicks?
Yeah, like when you get into a trade, me personally, I know you can't tell me how I should trade.
I don't necessarily do it, but let me tell you the difference between this trade and many other trades that you'll take as a trader. This trade is 618 pips. All I want to do is make sure I get in. I can do my damage once I'm in the trade. So you have to be smart. If this trade goes down and wicks you out and then goes 618 pips, is it more criminal that you lost that 1%? Or is it more criminal that you lost out on the opportunity to make several tens of percentage? So what I'm telling you, if I'm in a trade that goes 618 pips, I will probably make 25% on the minimum. Because as you add positions to it, you're going to get a better risk to reward ratio, right? So if you look at this trade setup, this says our risk reward is a 1 to 6, 1 to 6.8, which is darn good. That's great. That's double what most people shoot for in Forex, right? And that's with a 91 pip stop loss. Now, it's not going to happen over 2 weeks. This trade might play out over a 2-month time period. But the point is, this is a heavy risk to reward. Once you get in the trade, you might take another buy position on a 1-hour time frame, which is going to significantly reduce your area of risk, which is going to significantly boost your reward ratio. So maybe this takes 2 months to play out, but by the time it gets finished playing out, you've made 300% on your trade. That's not far-fetched. You might have 5 entries at a 1 to 55. That's 400% or 250%. So you've doubled your account twice during this meteoric rise. So all I'm saying to you as a trader is, the first thing you have to do to become successful is to get in the trade, right? All you can do is get in the trade. If you're not in the trade, you can't make any money. Once you get in the trade, I mean, you can make it dance. You can make it do whatever you want it to do. But that's the purpose of us trading these demo accounts, because I want to be able to show you how it works, right? I don't just want to tell you. I've been telling you how it works. People struggle with being told how it works. Then when they see how it works, it hits a little differently, right? Maybe what your problem has been all along is you use too big of a lot size. Maybe that's the problem. Maybe you didn't realize that your first job is to get in the trade. You can make the trade dance once you're in the trade. But if you don't get in the trade, or if you miss your trade for whatever reason, if you decide, hey man, I don't want to protect 90 pips. I don't want to have a 90 pip stop loss. I only have a $5,000 account. Okay. I mean, go ahead and chase your 1 to 3. When you get inside this trade, you're going to have opportunity to chase a lot more than a 1 to 3. But you just have to have the mental awareness to understand all of that. So does everybody understand the trade setup and how we got to this point?
Yes.
Okay, it's very important that we understand the setup and how we got to this point, because if you can understand that piece, when you start doing your own analysis, I'm sure everybody already does their own analysis, but for those of you who are new to trying to analyze charts, that was a perfect example of how we went from 0 to 100, right? We started out with a concept. The concept was that the market is in a narrow state.
Mm-hmm.
All right. From the concept, we zoomed out to look at what the market structure had for us. We realized that since March of 2020, this market has been pushing up, right?
Mm-hmm.
If we narrow it down from March of 2020 to now, we can see that we had the most recent break of this structure, right? These are relative equal highs right here. So some of y'all might call that a trend line. I don't know, whatever you want to call it as a trader. It's not really important what you call it. It's just that you recognize that we were in a channel here. We broke out, right? We broke out of this channel. We retested. Even though we're in the channel, the retracement came to your optimal trading entry and it tested your 200 period moving average. So now you're expecting to push up. Everybody see that?
Yes.
So that's how we got to the point. So these are our confirmations. And now all we have to do is take the trade. Once you have your rules met, you have to take action. So if your rules are you need 3 confirmations, once you get them, you got to get in the trade, man. I mean, you got to be a robot about it. Okay, I'm gonna go ahead and stop the video because I'm gonna post this video in the